Hi everyone, this is Alex talking to you about accounting fundamentals. Today I'll be discussing depreciation on assets and how that's recorded. So let's start with what is depreciation. And notice I have the accounting equation written up here for you again because as I discussed in my first video, everything can be traced back to this simple formula. But what is depreciation? I want to start with this. Depreciation is used in everyday language. The common understanding of it is like, my house, I bought my house a few years ago for $100,000, and now if I go on Redfin or some other website, it's worth $200,000. Or maybe the opposite. I paid $100,000 for my house, but now it's depreciated in value, and the fair market value of that house is now $50,000, for example. And so that word depreciation, as you'll see, there's two different uses of it. There's depreciation, our everyday use of it, our everyday common understanding, the fair market value of an asset, whether that's a house or equipment in your business, right? And then there's depreciation for accounting purposes. And I think the best way to understand that is this really important principle in accounting called the matching principle, okay, which it requires that you spread the cost of an asset over time because you're likely getting revenue, you're getting benefit from that asset over time, right? So you want to match your revenues and your expenses. So let's talk about some key terminology for understanding depreciation. So there's, first of all, cost. Cost, there's also historical cost or original cost. Those are terms you'll see. Those are all synonyms. We're just going to say cost. So cost, what you paid for it, right? And if you have some equipment for your business, as we discussed, that's an asset. That's going to go on, that's on the left side of the equation. That's going to go on the asset portion of your balance sheet, okay? Another important term is useful life, okay? This is going to vary based on what kind of asset specifically it is. The accounting guidelines, the accounting regulations will say, if it's this sort of asset, it's going to be 5 years. It is, longer or shorter if it's another type of asset. But this is typically going to be a given number. Like, so if you're an accounting student, you're going to be given a period. It's going to be 5 years or 10 years or 3 years. Then there is the salvage value, also known as residual value. And this is the amount, again, if you're an accounting student, you're somewhat familiar with this. This is the number that is what that asset is going to be worth at the end of the useful life, okay? So I'm going to say for useful life, period of years for cost spreading, right? Because we talked about you're spreading the cost of that asset. You're going to be it's not all going to be in 1 year. It's not going to be represented in 1 year because ideally you're getting multiple years of benefit, and so you're going to have multiple years of depreciation expense. So that's a term I haven't used yet, but depreciation expense is ultimately what's going to be affecting your income statement and your balance sheet, as well as accumulated depreciation. But before we go into that, let's make sure we're comfortable with these terms. So cost, what you paid. Useful life is the period of years for cost spreading purposes. Salvage value, it's an estimated value after the useful life has run. Now notice it's an estimated value. So let's say it's land, or not land. So let's say it's equipment, because land actually technically doesn't depreciate. We use a different term for land, depletion. So you have equipment, and let's say the salvage value is $1,000. After the useful life has run, you've depreciated it, but you might actually be able to get more than $1,000 for it. Okay, so again, this goes back to those two understandings of depreciation. There's the accounting depreciation, and then there's fair market value. And they're not necessarily going to be the same. So let's start to think about the journal entries and the eventual financial statements that will be affected. So when you're depreciating an asset, you're going to have these two main accounts. They are depreciation expense. And you see that word expense, so you know this is an income statement account. So in my first video, we talked about income statement accounts versus balance sheet accounts. So this is an income statement account. The other account that's going to be affected is a balance sheet account called accumulated depreciation. So depreciation expense, that's actually, when I say you're spreading the cost of the asset, the original cost or historical cost, that's going to be represented by this depreciation expense. Every year or every month, depending on your accounting system and practice, you're going to have this depreciation expense. But you're also going to have an entry for accumulated depreciation, right? Because every entry must have another entry because it has to balance. So I'm going to use a simple example here now. One more thing I guess I'll say about accumulated depreciation. It's what is called a contra account. Okay, so what does this mean? So we know because depreciation expense is an expense, right? Going back to our first lesson, if you debit it, that means you're increasing that, right? If you credit it, that means you're decreasing it. Accumulated depreciation, it's on the balance sheet, but what else do you need to know? You need to know if that affects the left side of the accounting equation, right here, or the right side. Because as we discussed, if it's on the left side, then a debit means an increase, and a credit means a decrease. If it's on the right side, so liabilities are equity, a debit, DR, right, short for debit. Debit is a decrease, credit is an increase. Accumulated depreciation is a contra account because when you are representing this on the balance sheet, your asset, let's say your equipment, is going to be represented at this original cost, this historical cost, whatever it may be. And then underneath it, so if you've ever looked at a balance sheet, that's how it's going to be represented. You're going to have the equipment at the original cost, and right underneath it, there's going to be a line item for accumulated depreciation, right? This right here. And it's going to be a negative amount. It's a contra account, right? Because what does it do? It reduces. It's like, think of it as like a parent and a son, right? So the parent in this case is the equipment, and the son, or like a parent company and a subsidiary, right? One is sort of the master, and then the one is beneath it. And so that's equipment, and that's accumulated depreciation. So accumulated depreciation, it's a contra account. It runs opposite to it because it's decreasing that amount. Sort of like how expenses decrease net income and equity overall, right? As we discussed in the first video. So because it's contra, because it's opposite, when you increase accumulated depreciation, you're going to do so with a credit. And when you decrease it, it'll be with a debit. Okay? And this makes sense. If it's contra, if it's opposite of what you do with assets, right, then the way you increase and decrease the accounts should also be opposite. Okay? So I hope that's clear. Now, to really bring it home, let's see an example. Actually, I'm going to keep these this terminology up here for now. So in this example, we're going to say that the asset, whatever the asset is, original cost, which again is how we're going to represent it on the balance sheet on the assets side, original cost $10,500. Salvage value $500. Useful life, 5 years. So you need this information. If you're given a problem and you have to figure out depreciation expense and accumulated depreciation, you need these 3 pieces of information. And sometimes for those of you taking a college accounting course, what you'll see is you'll be given actually the depreciation expense and the accumulated depreciation, and maybe one of these 3 will be missing. And then you sort of have to, it's just like an algebra problem to actually figure out, well, what's the salvage value or what's the asset cost, okay? So don't be surprised if you see that. All right, so what we are doing here is, well, we have to figure out what is the depreciation expense, right? So because how do I go from this to depreciation expense and accumulated depreciation? Here's how you do it. There's several methods of accounting, excuse me, of depreciation. A common one, probably the most common one, certainly for school, is called straight line. The straight line method. Okay. Pretty straightforward. Here's the formula. So cost minus, I'm just going to say SV, that's the salvage value, divided by useful life equals depreciation expense. So in every period, once you look at these 3 pieces of information, and you can figure out what the depreciation expense is. And the accumulated depreciation is just a summary of that, right? Because you keep track of it because, and that's how you keep track of it on the balance sheet, right? Because depreciation expense, that's hitting the income statement. And accumulated depreciation is going to be that contra account right below the equipment. And so you have the original cost, right, of the equipment. So the balance sheet's going to look like this. It's going to say like equipment, in this case, 10,500, and then right below it, it'll say, probably in parentheses, or in parentheses because it's subtracting from that equipment amount, whatever the accumulated depreciation is, right, at the end of the period. And then typically it'll say something like net, X, Y, Z. Okay? So that's, and of course I encourage you to look at financial statements, Google balance sheet, Google income statement to become familiar with those. So let's do the calculations. Let's do the journal entries here. First we have to figure out what depreciation expense is. We have our formula here. So it's 10,500 minus salvage value of 500 divided by 5 equals 2,000. Okay. Now that we have that information, we can record the journal entries. We know there's a depreciation expense per year. So let's say that in the year 2019, you're recording for your business, and remember DR and CR, short for debit and credit. You're recording depreciation expense of $2,000, and that accumulated depreciation, that contra account or contra asset account to be more specific, right? The asset being equipment, also $2,000. So the useful life is 5, so we have 2019, 20, 21, 22, and then in 2023, that's the last year that we're going to record depreciation for this asset because that's the last year of its useful life. And it's just going to be the same amount. That's what straight line depreciation is. So this method, straight line depreciation, there's other methods out there, but this is the simplest. You know it's going to be the same amount every year. Okay. Cumulative depreciation, 2,000. And that's it. And, the way you can check your work is, so we've had 5 years at 2,000, you're going to have total depreciation of 10,000. So 10,500 minus 10,000 equals 500. And that makes sense. It all checks out because you have your original cost. It depreciated 10,000. And what are you left with? Salvage value. These numbers all check out with the numbers you started with. So always check your work that way. Remember, you're not going to go below the salvage value. So once you've hit it, you know you're done depreciating. It's important to remember the difference between a journal entry and an account balance or total or summary. Okay, so a journal entry, it records a business transaction, and it's going to be an increase in an account or a decrease in an account, but your balance is going to be the summary of those. And I think this is demonstrated best with T accounts. They really help you stay organized with your journal entries. So the T accounts here that are relevant are depreciation expense and accumulated depreciation. If you've seen my first video, I've talked about this. Debits always go on the left, credits on the right. And then as I've said, depreciation expense, it's an expense, so you debit it to increase it, right? Credit it to decrease it. Accumulated depreciation as a contra to assets, the asset being equipment, so it's a contra asset. It operates the opposite way, so we debit an asset to increase it, we credit an asset to decrease it. Accumulated depreciation is going to be the opposite. So if you're debiting it, that means you're decreasing the account. If you're crediting it, that means you are increasing the account. So the thing about journal entries and depreciation expense is just one example. This is typically done on a monthly basis. So you know, we start with the yearly amount when we're working with our formula up here to get to depreciation expense, right? This cost minus salvage value divided by useful life. But depreciation expense is kept track of on a monthly basis. So let's just look into that a little bit. So 2,000 divided by 12 months is 166.66. Let's just, for simplicity, we'll just call this 167, okay, per month, right? So so here, these journal entries, 19 through 2023, I've simplified a little bit here. This represents the whole year, right? But technically, when you're working with T accounts, the T accounts, every entry is going to be a month, right? And then you're going to have an ending balance, right? So every T account represents the summary of the activity for a year. So let's just call these 2019. Okay, depreciation expense and AD. So beginning balance we'll just say is 0 for simplicity. It's important where you put it though, because you don't want to confuse yourself as to you know, what's increasing it, what's decreasing it as far as debits and credits. So right, expense 0 on the debit side, cumulative depreciation 0 is going to be on the credit side. So you're starting there. 167 per month. So 167 here, 167 here, and you know, the months go by, represented by these dots here, same amount, and eventually, right, it adds up to 2,000. That is your yearly depreciation. That's what I wrote here already because I was starting with the big picture, 2019 through 2023, the 5 years of the useful life of the asset. So just let's go one step further. My hope is after this video that you'll have a stronger understanding of depreciation, but also a stronger understanding of T accounts in general. So now we are in the year 2020, so the second year of the useful life of the asset, and I have accumulated depreciation again. And now the beginning balance is not 0, but 2000. Right? The end of 2019 is going to carry over to the beginning of 2020. Okay? And then it's going to be the same thing. You're going to have your monthly entries, right? And eventually that's going to get you to 4,000, and it just continues like that. Okay? So again, hopefully now you see the difference between some balances, totals, right? A balance at any given, at the end of any year, and really you can even look at it after a certain amount of periods, right? A certain amount of months if you're within the year and you want to see depreciation. So notice though that I didn't create a 2020 T account for depreciation expense. And that's something I'm going to talk about more in future videos, but for now just know that expenses, those balances, they don't carry over. So you can keep track of that, but the balance sheet accounts, there's that word balance, because that's the balance that you're going to have carry over to future years. So that's that. One more concept I'd like to discuss is related to this. It's net book value. And this is simply cost of the equipment minus your accumulated depreciation at a given point. And the point of this is just to see basically how much of that cost is left of that asset, of that equipment, for example, after a certain amount of depreciation expense has been taken. So in this case, and really what you should be noticing hopefully is there's a way to check your work. So if we know that the cost is 10,500, and let's just say that we're at the end of the depreciation, so 10,000, right? 5 years at 2,000 a year. Your net book value happens to be also your salvage value, right? But so your net book value is going to be the same as your salvage value once you're done depreciating. But this is a way to see the status of that asset earlier. And when I say status, I mean the cost minus however much depreciation has accumulated. So subtracted from that cost. And remember, again, net book value, depreciation, keep this separate from fair market value, right? Which is like, what is someone willing to pay for that asset? It may be the same as your salvage value. Remember, your salvage value is an estimate, but it may not be. So back to these terms up here. So I always start with the accounting equation at the beginning of each video, and I'd like to end on it as well. So we want to see how this actually balances. So we've seen the journal entry, we've seen that the debit equals the credit, but it all should link back to the accounting equation. So the assets, remember we talked about accumulated depreciation as a contra account to the asset. It's a contra asset, accumulated depreciation is. So when accumulated depreciation increases, that effect overall is to decrease assets, right? So in this case, if we're looking at 1 year of depreciation expense, accumulated depreciation, right? But that's the other side of the entry, right? So we debit depreciation expense, we credit accumulated depreciation to keep track of it. So assets overall have gone down by 2,000. Then the other side of the equation, right? It has to balance. The depreciation expense has lowered equity by 2,000. How did it do this? Well, we know that from the first video, in case you haven't seen it, revenue minus expenses equals net income. This is your formula for the income statement. If your expenses are going up, whether that's by depreciation or something else, your net income is going down, right? And the relationship between the income statement and the balance sheet is this. Net income is linked to retained earnings, Retained earnings is a summary of your net income, so your profit or your losses over the years. And retained earnings is a big part of equity, which is this right here. So as you can see, it all checks out, which is how you know you've done a good job. I hope this has been helpful. Please like this video and subscribe to my channel, and I look forward to discussing accounting with you further.